But let's proceed now with the last speaker of this panel, Paul Tucker, Sir Paul Tucker, who is currently a senior fellow at the Harvard Kennedy School and the Harvard Business School. Now, the two schools were fighting to get Paul on the faculty, and they had to compromise and to get one half of him each. But I understand it worked very well. Now, previously he was the Deputy Governor of the Bank of England from 2009 to 2013, and he joined the bank in 1980. So he has been a central banker for a long period of time, and during his period at the bank, he has been a member of all the major committees at the Bank of England, the Monetary Policy Committee and the Financial Policy Committee. He has also been a member of many international committees, including the Financial Stability Board. And during the dark years of the crisis, we had the opportunity to work together in a very effective and nice fashion. So I have appreciated very much his wisdom and effectiveness and knowledge of monetary policy issues. Paul.
Lucas, thank you so much for inviting me to be here today. As you know, this is a country I love and a city I love. Hiroshi, you should try to come here almost every year for the remainder of your life. That's what I've done so far, and I intend to continue doing so. You can never see too much of it. It is endlessly inspiring. And some of us were at the top of our hotel last night, and that was an inspirational moment, because from the top of our hotel, we're fortunate enough to be able to see two of the hills that form the foundations of our civilization, of liberal democracy. On one hill, the assembly met sometimes. This is the inspiration for democracy. And on the other hill stands the Temple of Athena. And one of the great stories that brings us to where we are in the world played out there, as most of, I'm sure all of you, certainly native Greeks will know. In the Oresteia, there is an absolute catalogue of disasters. Moral disasters and contingent disasters. And towards the end of the tragedy, the protagonists of the story go to the Temple of Athena for resolution. They are chased by the Furies who want revenge. And the Furies are dispatched because revenge and vengeance is no solution to anything. But instead, the answer is reason and justice. And this remains as inspiring 2,500 years later as I expect it was to the citizens of the polis of Athens 2,500 years ago. And actually, most of what I have to say is in a way to do with democracy and about reason. And let me say right up front that I thought it was absolutely tremendous that in this hall we could see a peaceful protest about what we, my ex-world, has done. Democracy is about peaceful protest as well as about voting in parliaments. I will talk about three things. Monetary policy and more or less where we are. Secondly, about banking policy and how that relates to monetary policy. And thirdly, about the future of central banking. One of the advantages of going last is that you can both agree with and slightly in some places disagree with things that one's colleagues have said, but they would expect no less of me probably. On monetary policy to begin with, I think it's tremendously important that central banks distinguish between those of their policies that are directed towards stimulating demand, spending in the economy, and those that are directed towards fixing the transmission mechanism of monetary policy, fixing the credit system, fixing the things that are impeding the effectiveness of monetary policy. And I'm not convinced that central banks are doing a great job at that. And I think it would help the citizenry of Europe and the United States, and indeed of the United Kingdom, if that distinction was sometimes made clearer. It is, of course, blurred, and it's not as easy as in normal circumstances, but nevertheless it remains important. The euro area has had tremendously low inflation, a threat of deflation. That doesn't mean that deflation is the most likely or central prospect, but it means that there is a significant probability of deflation occurring. And given the costs of deflation, this has warranted monetary stimulus, which is starting to come. And this isn't to do with the periphery economies. It's a dreadful thing to call them the periphery economies, and I mention the word only to dismiss it. But this isn't to do with the economies that are in crisis, Greece, Ireland, Portugal, Spain, to some extent, Italy. This is to do with deficient demand in the euro area as a whole, and the case for monetary stimulus is to increase demand and bring inflation back to the target of 2%. And what that means for the euro area as a whole is that inflation in Germany will be somewhat above 2%, and inflation elsewhere will be somewhat below 2%, and that is fine if the euro area as a whole is to have 2% inflation, because the target is for the euro area as a whole. Now, there is a risk which weighs with central bankers, that by providing time, and I think Lucas talked about this, that maybe central bankers will relieve elected politicians of the incentives to fix the underlying problems in the economy, in this economy, in France, Italy, or elsewhere. And that risk is real. But central bankers have absolutely no right whatsoever to succumb to that. And I was disturbed when an institution of which I served on the board and was privileged to serve on the board, the Bank for International Settlements, raised the prospect in its last annual report that maybe central banks should provide less stimulus so as to increase the incentives on politicians. No one here as central bankers was elected. Each of us, when we were in office, were given mandates from elected politicians and therefore from the people to pursue an inflation target, and that is what we must do, or our successors must do. And if that means that the politicians succumb to the temptation of not reforming, then it is they who have to be accountable to the people, rather than central bankers being seduced into playing politics with the politicians. I must say, I think to a large extent, central bankers have resisted that temptation. I say this to put it beyond doubt that those of us that served as central bankers felt strongly about the legitimacy of the mandate that can only come from elected representatives. The other thing I would say about monetary policy, though, as it bridges to one or two things I want to say about financial stability, is to overstate it. I don't completely agree with Don about monetary policy in the run-up to the crisis. It'll probably be 20 or 30 years before economists pin down what happened, but I do think that loose monetary policy, and in particular the promise of persistent loose monetary policy, partly fueled the search for yield and the excessive balance sheet risks that were taken. I don't think by any means it was the main cause, nor do I think the global imbalances associated with the rise of China were the main cause. The main cause was absolutely woeful regulatory policy. But nevertheless, I think it played a part. Where I agree with Don is that, the way I would put it is that central banks need to be less bothered about short-term volatility. By making promises or appearing to make promises about a smooth adjustment or gradual adjustment in interest rates, central banks can trap themselves where if they appear to diverge from that, the market's horribly volatile and then they retreat back. If central banks set their interest rate policy or their monetary policy on a judgment of what is happening to the amount of slack in the economy and the outlook for inflation, sometimes markets will get that wrong and will overshoot, but will discover over time that they were wrong in their interpretation of central bank policy, and they will lose money in the process, and they will learn to listen. And it is better for the market to have to lose money occasionally than for central banks to find themselves boxed in. And I say that because I think that is a risk over the next few years. Let me now say something about monetary policy and banking policy, and first of all about the design of the monetary union and banking union, and then secondly about macroprudential policy. The monetary union was badly designed, and your citizens and citizens elsewhere throughout this continent are suffering as a result. And that's done. There's no going back. Reason, not vengeance, is the way forward, but it needs to be recognized. And so where does that leave us on the banking union? The next panel is about the banking union, so I will make 2 points very quickly and then elaborate on one. I think it's tremendous that banking supervision is moving to Frankfurt. I don't at all agree with people who think there is a conflict of interest between supervision being in the central bank and combining it with monetary policy. I think the resolution mechanism is good. The decision-making structure is, yes, somewhat cumbersome, but I think national authorities will be most unwise if they don't defer to the center. The bit that worries me is the deposit insurance. Think of it this way. What a monetary union is, it is a union of money, and there are two types of money. There's the money that central banks issue. That's a relatively small amount of money that circulates in the economy, and there's deposit money with banks, which is nearly all the money that people and firms use. And if you are to have a monetary union, that second type of money, deposit money, needs to be homogeneous as well. And the deposit insurance package is problematic in this respect. Better either not to have deposit insurance, which I think is completely infeasible in modern democracies, or alternatively to have a unified deposit insurance scheme for the euro area as a whole. And that, of course, has implicit in it an element of transfer union. But this is the great question that the euro area will have to confront in the years ahead. I think the designers of the banking union have done a good job, but it will not be enough to ensure the sustainability of the monetary union over the long run. Eventually, there will have to be some kind of fiscal union. I hope myself that it's something like a cyclical unemployment benefit. I believed from the beginning of the crisis that it ought to be possible for states to default within the euro area, just as states of the United States can default within the federal union of the United States. But the people should not be victim entirely of the mistakes of their own governments and authorities. I think for the continent of Europe, the euro area, to have solidarity, I think there has to be some kind of cyclical social transfer mechanism. I recognize that that is potentially controversial around Europe. Macroprudential policy, Don has mentioned this. I think I agree with pretty well everything Don said about this. The object of macroprudential policy has to be to sustain the resilience of the banking system in particular and the financial system more generally. I don't think it can be engaged in some incredibly ambitious fine-tuning of the credit cycle. So I think monetary policy should be used for macroeconomic management, and macroprudential policy should be used to ensure the resilience of the financial system, and that will have the effect sometimes of leaning against the boom phase of the credit cycle. So where, finally, does this leave central banks in the future? I agree with Ben that their balance sheets are going to be bigger. And in fact, I think they're going to end up not with 2, but 3 balance sheet policies. One, the interest rate. Secondly, in a world where they pay interest rates on balances that banks hold with them, they're going to be able to choose the size of their balance sheet as an independent matter. And then thirdly, they're going to be able to choose the assets that they hold. But like Don, rather than Ben, I would prefer to keep the innovations that have been employed during the crisis, and I'm proud of the innovations that I was associated with in the UK, but I would prefer them to be kept in the locker during normal times, and that's for 2 or 3 reasons. The first, and for me the most profound, is that I think it's tremendously important that Parliament's citizens can make sense of what central banks are doing if they are to be able to criticize central banks. And I think that is made harder if central banks are using lots of different instruments. But secondly, I do think that central banks need to take care in normal circumstances where it's probably unnecessary in buying private sector paper, because that does involve intervening in the allocation of credit, and it does involve a risk of loss or a risk of profit. And as Ben quite rightly described, of course, taking a loss doesn't undermine the central bank in some way, but it does mean that the income that goes to the government will be smaller, and therefore taxes will be higher, or spending will be lower. And there is a risk of that politicizing the central bank. But more importantly than whether or not central banks should employ these tools in normal circumstances is, in my view, the following, which is, if they are to employ these tools, it needs to be under a mandate given by elected governments. Legitimacy, central banks can't create their own legitimacy, however good a job they do. The legitimacy has to come from elected people, and in Europe, that means the Council of Ministers and the Parliament. And if I could finish on one note, I'm sure that Ben didn't mean to imply that the whole of the European Parliament is rotten. I think there are many, many good and decent people who would celebrate the importance of reason and justice and democracy, and they will win. Thank you very much.